financial institutions, not all of them, but some of them have some very cancerous assets in their portfolio. And some of these are very highly leveraged institutions. And their ability to manipulate their valuation of those assets can materially impact the value that the investment community might place on that institution. While I understand there are other institutions that are holding assets and they may be of a different quality, I think one of the problems with the whole subprime and all of the securitized transactions that we've done, they're very complex, they're layered, and very hard to identify exactly what is the actual risk within those portfolios. So one of the things that I think has to happen here is that we have to make sure that we don't lower the standards so that we can allow institutions that maybe shouldn't continue to be able to operate or shouldn't be operating somehow to give them a free pass while at the same time making sure that we are, the investment community is rewarding those companies out there that are actually managing their business in an appropriate way. The question I have, I think, Mr. Bailey, you mentioned that you had taken a write-down, but do you have a model that you use to evaluate your mortgage portfolio to determine what the value of your portfolio is?
Yes, sir. I guess we follow the FASB guidelines right now, but in that instance, we're looking at a mortgage security that is basically has some credit issues in it. And as we do a rigid credit analysis, we say, okay, using the example, you pay $1 for it, there are credit issues, it may be only worth 90 cents. But because you have to go out and get a market price for it, and no one is in the market these days, and they quote you 60 cents, you're taking a charge of 30 more cents than the difference between the 90 and the 60.
Are you using an internal model, or are you using a recognized model?
We're doing the analysis, but then the FASB guidelines, as I understand them, would require you to write down to the market value.
Yeah, but I want to be clear, you're using FASB guidelines, but you're using your own model.
Correct.
Is that correct?
That's correct.
And so another bank that down the street might be your competitor may believe that he is following the FASB guidelines and he's using his model or her model. That could be a different valuation, and is that correct?
That is correct.
Yeah, and so then how do I know then what the condition, if I've got both banks side by side, how do I know which is the healthier bank?
I'm having the same problem, Congressman. I guess one of the examples is we rode down to Washington. We were looking at talking about different banks and their financial statements that were out. All big accounting firms came out and had analysis. It appeared to me, Tom Bailey, the banks that got TARP took big write-offs. The banks who didn't did the analysis and came up with a number. All the accountants signed off on them. But here is where I see the taxpayers and you are footing the bill for the uncertainty in this rule.
Well, I think there is opportunity out in the marketplace if there was an ability for investors to understand the actual condition of a lot of these institutions and maybe a lot of these securities. I'm told that there are ways to dig down into those portfolios and actually determine those. But what those people also tell me is that that is the assumption that this is as worse as it gets. And that this, where we saw in the headlines today, is that foreclosures actually increased in the month of February, and Freddie and Fannie actually had a moratorium on foreclosures. And so what we do know is the universe isn't static and that things are getting worse. I think one of the questions I have to the panel in the short period of time I have left is if you could use a market evaluation process that everybody uses, but use a disclosure model, box or a addendum that says this is the assets that we hold. We're currently valuing these assets internally based on this. Now, this is the way we have to disclose them. But if on your balance sheet you disclosed how many you have, what your default rate is, what your projected cash flow was on the security when you bought it, what it is today, obviously the industry could develop some standards. If that was in your footnotes, then I think possibly that would bring some transparency to the marketplace where I could then make a decision whether to invest in your bank or Mr. Cotton's bank or somebody else's bank. Would the panel respond to a suggestion like that, Mr. Mahoney?
Thank you, Congressman. Fair value by itself isn't sufficient. There needs to be robust disclosures around fair value. So an idea along your lines we'd certainly be supportive of. The white paper that I attached to my testimony does include a recommendation about some additional disclosures, particularly with respect to the hard-to-value assets. So that'd be something that the investor community would be very supportive of, to have more robust disclosures around both impairments as well as mark-to-market or changes in other changes in fair value. Thank you.
Okay.
Yes, Congressman, I would note that the Securities and Exchange Commission currently allows that type of disclosure, not in the footnotes to the financial statements, but in the management's discussion and analysis. So there's nothing to prevent management from making those kinds of disclosures about the assumptions that they're making, about their cash flow predictions. And in fact, one of the recommendations that the Center for Audit Quality made in its November comment letter was to have the SEC to give even more clarity around that so that people are comfortable using that mechanism of disclosure.
If I might.
Mr. Isaac.
Yeah, I'd like to respond to that. I think that, first of all, I'm all for all the disclosure anybody wants to make. The problem we have here is they're running these losses, these market losses, through the income statement, which scares the public when they see multi-billion-dollar losses being announced that aren't real. The public doesn't know they're not real, but they're not real. And they're disclosing, and they're running it through the capital account. And for every dollar that goes through that capital account, you're diminishing $10 of bank lending capacity. So I'm all for all the disclosures you want to make, but you don't run these mark-to-market losses through the income statement and balance sheet. That's the problem with this accounting system. And let me just take this, and what we do need is bank examiners and accountants in there with their sleeves rolled up, giving these assets a true economic value so we can all know what they are. But this in my chart here, we've got a bank that has a portfolio that it expects. This is one bank and one portfolio in that bank. They've taken nearly $1 billion of write-offs that don't need to be, because their belief is, their firm belief is, based on economic analysis, is that the losses in this portfolio will be zero. Worst case they can come up with is $100 million of loss. They've had to take a $913 million loss with this mark-to-market rule. And so we just destroyed $1 billion of capital in this bank needlessly, which is $10 billion of lending. And that's just one portfolio in one bank. So the problem is we're destroying capital, and we're taking it out of earnings, and we're scaring the public and making them think this problem is worse than it is.
Thank you very much, Mr. Neugebauer. And Ms. Kapler of Ohio.